Today we are recording the third episode of the Baird Retirement Management Show. We are joined again by Scott Bartosh and Greg Ashcroft from the Ashcroft Pesek Bartosh Group. Scott is a certified financial planner and is a director with the Ashcroft Pesek Bartosh Group. Scott has worked as a financial advisor for over a decade. Greg is a chartered financial analyst, a certified financial planner, and is a senior vice president with the Ashcroft Pesek Bartosh Group. Greg has worked in the industry for 9 years. Today, we are discussing the potential that the tax code sunsets at the end of 2025. Currently, the Tax Cut and Jobs Act is set to sunset at the end of 2025, absent some government intervention to extend or rework the tax code. To kick things off, Scott, tell us how we got here. What happened back in 2017 to give us this current code? And what might happen starting in 2026 if we don't get a new code or this reverts back to a pre-2017 tax code?
Yeah, so in 2017, with a new administration in place, they had the mandate, I guess you could say, to change the tax code and make some adjustments. While we still had the same number of brackets, what happened was they made some pretty significant changes to just the way that people filed, the way that income was taxed, the corporate tax rate came down, a few things of that nature. The biggest changes, though, from what we had previously was the top marginal rate, or the rate on people making a lot of money, over $600,000, $700,000 in all likelihood, went down slightly. And then across the board, there were some more minor changes to the way that the brackets worked. It also took away something that was very popular in the previous code, which was using state and local taxes to augment your deductions to make more people itemizers of their taxes as opposed to using the standard deduction.
And Scott, under the Tax Cuts and Jobs Act, you could still take a deduction for your state and local taxes. It's just capped at a pretty low rate. I'm pretty sure it's $10,000, and the lift, so to speak, as to become an itemizer under the Tax Cuts and Jobs Act was pretty stout, as in you had to do some pretty aggressive charitable giving, or you had to have a very large mortgage, or you just, in all likelihood, were not going to be an itemizer. It seems like if we get a sunset and we get a reversion back to the pre-2017 code, we might see more people finding themselves itemizing their deductions again.
Yes, more people will itemize, and that was the case before the 2017 changes. So, yes, I think adding back in state and local taxes and, that it's going to be a bit significant mover just in terms of if you have one of those larger mortgages, you're fairly charitably inclined, that's something that might move you over the top to be an itemizer again.
Okay. And I think that for the purposes of our discussion here today, we don't want to get too hung up on the specifics of what might happen if we get the sunset. And there are reasons for that, which is right now we could say that the putative stance is if nothing happens congressionally, yes, we would get this sunset. However, the Harris administration has already been publishing and talking about some specific changes that they would make to the tax code if they could have their way. But the Trump administration, though that the Tax Cuts and Jobs Act was written under the prior Trump administration, they're already talking about some changes that they might make to the code, and the specifications there are something that we probably won't touch on today. And the reason for that is we really don't know. We really don't know what's going to happen at the end of 2025, and so we're not going to spend – I don't think we're going to spend an inordinate amount of time discussing the particulars of all of those various changes that might or might not come to pass in the tax code, and instead really gear the discussion towards something a little bit more practical, which for our business is talking to retirees who are, entirely entitled, I would say, to be concerned about major changes to the tax code, particularly those who have large balances in tax-deferred accounts. So this would be in an IRA, or maybe you're still working, you have a very large balance in a pre-tax 401k. And so I think we want to get into some of the things that a person might be able to do if they're worried about changes to or major changes to the code. And I know, Scott, that something you've been kind of raising as an issue, particularly to our younger clients, is to say, maybe we got a little bit over our skis with having this goal of always contributing the maximum you could to your 401k plan, as an example. Could you touch on that maybe?
Well, and just to touch on one thing from your prior note, I think we touched on this in our Roth session last time. I think trying to predict the tax code and do things now based on the assumption that rates are going to go way up or way down, it's kind of a fool's errand. And it may work out for you, it might not. And so I think we use what's available and what we actually know to make the best planning decisions that we can. Mm-hmm. So, but on the point that you just raised, I would say one of the things that I talk to people about is, and these are drastic examples, but like Mark Cuban, Donald Trump, like you said, Warren Buffett, they're not really wealthy because they maxed out their 401ks or they maxed out a Roth IRA. They're wealthy because they made a lot of money in an after-tax account, and they have spendable sources that they can get access to, say, before their retirement age or before 60, as an example. And so what I typically counsel people to do is, absolutely look to take advantage of a corporate match. If your employer is going to match 6, 7, 8% of what you put into your 401k, try to get that for sure. But, scrimping on essentials in order to try to max out your 401k, it might not make the most sense, because at the end of the day, if you want to think about stuff like retiring early, say before age 60, what you're going to need is liquidity in an after-tax account. Those accounts are also really favorable in the way they're taxed in the current code. Capital gains are at a much lower rate than ordinary income. It depends on what bracket, but it could be as low as zero if you don't have a lot of other income, say in retirement. So I tend to like the idea of not having all your eggs in the qualified basket.
Yeah, and I think that we don't want to be, because I know this is getting a little bit popular, the whole 401k is a scam to keep you employed and all that. We definitely don't traffic in those circles, because we think that if you are a very high income earner, say, and you're paying on the margins of your income 37%, then we would probably go to you and say, you have sufficient income to be getting all of the current tax deductions that the government is going to afford you. Because if you're a high income earner, it is very likely that you are going to have some additional income beyond that contribution to your traditional 401k and IRA, where you can start building up value in a taxable account. And I think previously, when we didn't have very efficient vehicles, or were these really efficient vehicles, exchange-traded funds being a primary example of that, were just not as well known to people, they thought that the only real way to defer taxes was to save that money in an IRA or in a 401k.
Yeah, or it used to be very popular for high-income people to go an insurance route there, like
right.
Annuities or life insurance. And you can still do that, but you don't have to. Just as a quick other note, there are other non-liquidity related reasons that you might want to get after-tax money into one of those plans. One that we work with a lot is the ability at retirement to use something called net unrealized appreciation. It's really in the weeds, and it may not be something that applies to your specific plan, but the idea is if you bought some stock in a company that you worked for 40 years, you might have some shares with a really low basis. If you have some after-tax money in your plan, it can really save you some taxes down the road if your plan allows you to specifically identify some of those low basis shares.
Yeah, so I think that having a little bit of tax diversification, definitely easier, I think, for a person early in their career to make contributions to a variety of accounts rather than just piling all of their income into, say, their 401k plan. Now, like you said, I think if you wanted to have a bit of a savings order of operations, we would certainly be in favor of contributing enough money to an employer-provided plan in order to get the match. The only guaranteed 100% return on your money is a company match, right? If you don't get the match, you've essentially taken a salary or a pay cut, as an example.
Mm-hmm.
But we also don't want people to lose the fundamental thread of what it is that they're doing in their 401k plans or in their IRAs, which is you are deferring tax, but you're taking the growth on those assets and you're turning 100% of that growth into a deferred ordinary income item. And now with really tax-efficient vehicles that you can own outside of an IRA, you are essentially paying income taxes on the front end, yes, but you're turning all of the growth on those assets into a capital gain item. Or for many of our clients who are now retired and relying on IRA distributions for their income, you're turning all the growth on that asset after tax into a tax-free accumulation vehicle because of the step up in cost basis. So I think a lot of people have developed a severe allergy to this notion of capital gains when really there's going to be a select few who never really pay a capital gain on some of those assets.
That's true. And, it's a great problem to have, but sometimes you do really, really well in a 401k. You get the match for a very long time. Maybe you buy some company stock that appreciates a lot, and you end up with an IRA balance that becomes kind of punitive when you hit age 78, 80, because your required minimum distributions are huge. So in retrospect, maybe trying to get some more of that money into a non-taxable account, like an after-tax account, would have helped out pretty dramatically.
For sure. I think another thing that people are concerned about with this change to the code is the estate exemption. Mm-hmm. So the estate exemption right now is at a historic high. I'm not sure what the number is exactly, but I think as a married couple, you have more than $26 million that you could pass down in your estate, and that would be free of estate tax. And I think people are very concerned about those thresholds being dramatically lower after, say, the end of 2025. Now, could you just get into why, as financial planners for retirees, many of whom who've done quite well, we're not that concerned with a lower estate exemption amount?
Well, we're not, because if we're tying this back specifically to the sunset, which is the conversation that we're having today, I think the inflation-adjusted estimate of where that would be is probably something like $13 million for a married couple if we just had a sunset. So, not that many people have $13+ million. And
I mean, under previous codes, the number of taxable estates, that was super low, wasn't it?
Yeah, I don't have the exact number in front of me, but it's not a huge number of people that were ever paying the estate tax. It's not a huge generator of revenue for the government.
And so I think what you're getting at is, even if the exemption amount, which is just the amount that you can pass down through your estate without being taxed, even if that were cut in half, as an example, probably not going to change the estate plans for the vast majority of investors today.
Yes, I would agree with that. And I would say that if you are in that group that you think that if you're retired already and you have something in excess of probably $10 million, you should probably talk to an estate planning attorney in the next year and a half before the code potentially could sunset, without us making a prediction on if it will or not.
Okay, and then another thing that I think we wanted to touch on was, because our business is primarily with retirees, is that there are a number of tax incentives or some tax opportunities that become available to a person once they are retired. I think primarily is you are allowed to take distributions or qualified distributions from either your traditional IRA or your Roth IRA. But one that a lot of people sort of, I think, have systematically overlooked, especially with the changes we got with the Secure Act and then the second iteration of the Secure Act, was mandatory distribution ages have gone up. So if you were born after 1960, your RMD is now, your required minimum distribution age, or your required beginning date, is age 75. That's new. If you were born slightly before that, the required beginning date is age 73. However, what was left at age 70 and a half, which used to be the age at which everybody had to start taking their RMD, was a qualified charitable distribution, or a QCD. And a lot of people overlook this because they feel like, well, I have to start taking money out of my IRA at age 73 or 75, so I'm just not going to until then. But if you're a charitably inclined person, even if you've been itemizing, why might it make sense to go ahead and leverage the qualified charitable distribution as opposed to continuing to itemize on your return?
Well, there's a couple of reasons. And like you mentioned, where the itemization threshold is important for this. Because if the tax code sunset and itemizing is a little bit more popular, maybe this advice changes. But right now, one of the things that we tend to find, say you're 75, you don't have a mortgage, and your property taxes are capped at, say, $10,000. So unless you're pretty charitable, you're not going to be able to itemize. So once you hit that threshold of 70 and a half, using a QCD can be really effective and attractive because, one, it gets money directly to a charity and it doesn't ever even touch your AGI or your adjusted gross income. So it's going to be goes straight to the charity, but it's not going to increase your taxable income for that year. That's attractive. The other thing that I think people don't think about so much is if you're in that situation that I mentioned before where you've got these huge RMDs, it retires your RMD up to $100,000, and it just generally reduces the size of your IRA balances, which are less efficient to past year heirs.
Yeah. So on the QCD, just so people understand the mechanics of this of what those are is, that is a gift to a qualified charity directly from a tax-deferred account that is done in a tax-free way. And the charity receives this money tax-free because the 501c3s are not going to pay taxes on income. They're not going to pay taxes on appreciated property. Now, QCDs have to be administered in cash, so you can't gift out shares, say, of a highly appreciated stock in your IRA. It has to come in cash. But as you alluded to, the real key here is when you do a qualified charitable distribution, if you're of RMD age, that counts towards your RMD in a tax-free way. And if you're not of RMD age, you can remove money from your IRA tax-free and have it not influence your AGI. And I think that if, say, we do get a sunset of the code, that particular bit of wisdom, which is to say you can remove cash from your IRA and not have it affect your AGI, is important, especially if more people are going to be itemizing. Because a lot of those deductions that you can take as an itemizer are AGI sensitive. So there's essentially a threshold of your AGI, 2%, 7.5% for some. We won't get into the particulars here. But just knowing that, hey, wait a second. If I can keep my AGI low and we're going to be moving into maybe a tax code where itemization is a real possibility for me because the standard's been so high lately that a lot of people have been taking the standard, you're going to want a low AGI or an AGI as low as you can get it, but you still want to, if you're a charitable giver, a lot of people are doing this out of a closely held personal conviction. They're not going to give that up, but this is a really neat way for you to be able to do a QCD, and that doesn't preclude you from itemizing, and it wouldn't preclude you from taking the full standard today either.
That's true. So I think to wrap up, going back to our initial conversation, it's likely that something changes at the end of 2025. That could be depending on how the election goes, where Congress ends up. It could be more favorable, less favorable than today, or maybe we just get a rollback to what happened before 2017. We're not sure about that, but let's be thinking about it so that directionally, we're prepared. I would also just touch on the fact that we should be looking for changes to deductions, exemptions, and whether or not you're going to itemize in the future. It's possible that changes that are coming, say, next year or the year after, could move more people to a place where they're itemizing. I would also say that there's potential for estate tax change, where the threshold at which the estate tax would apply could come down, maybe somewhat dramatically. But as we said, we just don't see that many people that are in a taxable estate area. And so I wouldn't be too concerned about that. And then finally, look at using some of the things that are available to you now that can provide quite a bit of benefit, like qualified charitable distributions if you're over 70 and a half, looking potentially at, if you're still working, generating some income that is in a more diverse location. We talk about asset allocation. I like to talk a lot about asset location, because if when you get to retirement, you have a really nice blend of IRA/401k, Roth IRA, and then after-tax money that's fully liquid, doesn't have any hurdles to get over for taking distributions, that I think is kind of winning the retirement ball game, so to speak. Greg, what else would you add to that?
I think you covered it. I think that does it here.
Scott, Greg, thank you both for taking the time to walk us through this today. And to all those listening, thank you. To make sure you don't miss any future episodes, you can subscribe to the Baird Retirement Management Show wherever you get your podcasts. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. This broadcast may not be reproduced without express permission of Robert W. Baird & Co., Incorporated.